Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
You're watching Stockwatch. I'm Zinati Guma, and joining me to unpack your stock-related questions today, our grant data from Benguela Global Fund Managers and Jean Pierre Verster from Protea Capital Management. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Thank you so much for your time, gents. Of course, all of the market jitters have been because of rare earth minerals, and we actually have some people that are trying to kind of eke out opportunity from this. When the whole market is panicking, they're trying to figure out where they can actually get returns. So starting off with you, JP, what are some rare earth players to look out for? ETFs maybe, REMX Van Eck, rare earth and strategic metals ETF. That's an example. What are the panel's views on this sector? Risks, outlook? Yeah, we've actually never had questions on rare earth minerals until now. JP.
Yes, good evening, Zanati. An interesting question. And maybe it's posed to the wrong person, because I can tell you that in general, I'm not a cynical person, but I am a skeptical person. And what that means is when there's something new that grabs everyone's attention, I normally do not get excited about it.
Okay.
That's just my nature. So what that does mean is I generally don't get pulled into a bubble, which is good. But it also means that I sometimes lose out and I miss a big opportunity, which is not a bubble. So I missed Bitcoin, for instance, just because I don't believe in Bitcoin. I missed the big jump a number of years ago in cannabis stocks.
Oh.
I've missed the spike in gold, and I can tell you I'm missing the spike in rare earths and in quantum computing. So that's just the nature of things. I don't have FOMO.
Yeah.
I don't have the fear of missing out. I'm okay to miss out, because the things that I focus on might not go up 50% in a day that some of these companies do, but invariably most of them, not all of them, but most of them at some point in time also fall 50% a day or fall 99% in the course of a year when the bubble deflates, and I miss out on that as well. So it depends on if you're an investor that likes this excitement, the ups and downs of excitement, then you can invest in the types of ETFs and single stocks that you mentioned. You can actually look at the big movers of today. You'll see a number of rare earth minerals in that list. I don't know the names by heart. Or you can, like me, just pass, and it means you need to be okay standing outside and being sober while people are getting drunk inside at the party.
Oh dear, it's raining and you're caught outside watching through the window. Grant.
That's no fun.
Yeah,
I'll join the party.
Okay, are you joining the party?
I won't. So I know the only stock that comes to mind is MP Materials, which is probably the furthest and most integrated rare earths mine in the US. The government's backing it. They want look, but this looks very frothy. This is very racy to be playing in the stuff. So you need to trade this. Don't get any ideas about this being an investment, and don't get any ideas about putting a lot of money in there. But if you're feeling the itch and you don't want to just watch the party from the outside the window with JP, play a little bit. But I would go with an ETF. Because at least you take away the single stock risk by doing that. Because let's be honest, none of us have really good knowledge of any of these companies in rare earths, and most of them aren't even making money. So you are playing the hype game. The only reason there might be some legs in this trade, along with this massive volatility, is that strategically, the sovereign imperative of owning a rare earth supply chain is very important, and more now so than ever. So I think the hype and the demand will be there for a while. It's not a rare commodity, these rare earths, but it's a very messy business. So a lot of the developed world has chosen not to be processing and making these things and let China deal with it. But they can't do that anymore. So they need to secure the supply chain and make their own and process their own minerals. So So I think the story's not going to go away, but I cannot tell you if there's value in these things because it's been a wild ride. I think they're up 500% year to date or something, or the MP materials is. So be careful,
Okay.
but have fun.
Okay, well, talking about froth, we know that that is really a common denominator for many growth shares. But this viewer is asking if you can please suggest 3 growth shares at reasonable value. JP.
Sure, 3. I would say, and I'll stick to offshore because we don't have that many growth shares really in South Africa. And those that we have aren't really trading at reasonable valuations. So I'll give you a bonus. I'll give 3 SA shares which not necessarily are trading at attractive valuations, but they're really good growth shares.
Okay.
And those I would say are We Buy Cars, Outsurance, and Boxer.
All right.
But I'm questioning if it's reasonable valuations.
Okay.
Then on the offshore side, there's a few that are trading at reasonable valuations, but the question is, are they real growth stocks? And there I would say a company like PDD Holdings, for instance, the holding company of Temu. People are questioning whether it will continue to grow, but it is trading at reasonably attractive valuations. And then generally, in China, something like Alibaba as well, it's up sharply year to date, but it's still trading at a reasonable valuation. So there you have 2 Chinese names. And in the US, wow, that's very difficult to get growth at a reasonable price in the US. If I had to choose one, I would say AutoZone. It's a car parts retailer. They are still trading at a reasonably attractive valuation, and they're still growing nicely on a per share basis.
Yeah, really interesting that in all these geographies, the US was your last one, and even there, you didn't go into tech. Grant, how would you be approaching this? Growth shares at a reasonable price.
Yeah, that's really a nice sweet spot to play in if you can find it. So I'll just add a few names to JP's mix. I certainly agree with what he put out there. Another great stock that I think has got a long-term growth trajectory is Karoo. You know, Cartrack, the old Cartrack, a great business with great management. I think PSG Consult is a growth story, and it's above other financials, but it's there for a reason. It's got a quality premium. So just because it's got a higher multiple doesn't mean it's expensive. It's reasonable relative to the quality. So it's also that relative valuation that one needs to consider. And then I think looking overseas, I think Tencent is still a great growth story with really relatively attractive valuations compared to some of the global counterparts, the likes of Google and the rest in the US, which are, it has the similar business to a Google and a Meta and some of these great companies, but it's just trading a lot cheaper. And of course, it's got a captive market in China. So I think that's a great one. I think I've said Tencent. Uber's one that I like. Okay. It's not that cheap, but it's not as cheap as some of the other growth stocks. And I think it's a bit underappreciated in terms of its growth potential, especially utilizing AI. So that's one I would think about. Yeah, I think I'll stop at those.
Sticking with you, Grant, you mentioned Tencent. Would this sentiment filter through to Naspers and Prosus as well?
Sure, definitely. Yeah.
Okay. All right. So if you don't get Tencent, then get in through Naspers and Prosus. All right. As we're talking about China, JP, there's a specific question here for you. Your view on CATL, CATL, the largest EV battery manufacturer in the world.
Yes, it's a great business. Firstly, they dominate the technology in EV batteries, lithium-based battery technology. They do compete with BYD, which is the company that we own in our funds. The difference is that BYD use those batteries in their own vehicles, while CATL sells their battery technology to third-party EV manufacturers. CATL until earlier this year was only listed on the China mainland, so you couldn't really buy the shares. And then they announced they're going to invest in China, they're going to list in Hong Kong. So for the first time, most foreign investors, including retail investors, will be able to buy CATL shares due to the listing in Hong Kong. The last time I looked at CATL, it wasn't too expensive, but based on the listing in Hong Kong, what I read last time was that there was a gap that opened up because of the listing. And if you can buy it on onshore Hong Kong, those shares, they're trading at a more than 20% discount to the same company shares that are listed in Hong Kong. And that's just because of this dynamic that almost anyone anywhere in the world can buy shares in Hong Kong, but really only Chinese citizens and those with a special license outside of China can buy shares that are listed onshore in China. So because of that dynamic, I would maybe wait for that gap between the onshore and what they call the offshore shares to close. But it is a great company that one can definitely consider for the long term.
Yeah. Well, I mean, just as we're on that kind of green energy dynamic, Grant, there's another one that someone has mentioned, Centrus Energy Corp. I bought Centrus Energy Corp last year as a picks and shovels play and have seen 607.71% profit. Every time I take profits, it keeps climbing. With energy demands climbing, what could the future outlook be like? What is a good strategy going forward when it comes to energy? So we've spoken about cattle, we've spoken about essential. What is your approach when it comes to that energy landscape?
Yeah, look, I think we can all see the energy demand profile is tremendous, and I don't think it's going away. The question is where can you find opportunity? And I think batteries are going to play a massive part, because someone's got to solve for the variable supply of power from the wind and solar solutions, and that's causing a lot of problems. So there's going to be a look back into, you're going to see gas turbines. I think the next 5 years are going to see massive demand there, because the nuclear solution is still 5 to 10 years away, which is the longer term play. So I think nuclear is a good area to play. But I can't see anything that isn't overpriced at this stage in that space. I think some of the providers of these gas turbines are great opportunities. Also, though, it's not an undiscovered secret. So you're going to have to do your homework there. And the battery providers, I think, will be part of the mix. So if you can find a reasonably attractive price one, I do not know Centrus well. I'm not even going to try and talk to that stock specifically. But I do think energy is a long-term story, and yes, take some profits, but try and stay invested in some of it for the longer term.
Let's get into more questions. I want to start off with Mondi. Comment on Mondi, please. And Grant, I want to come to you because I was looking at the stock and it's slightly up, but I mean, it's no difference to the sharp declines that we've seen on the stock. I'm thinking maybe there are some people who are trying to buy what they maybe see as the bottom. What's your take on Mondi?
Mondi's a tough one. I've been proved, well, I wouldn't say proved wrong, but I have probably been interested in this one too early.
Okay.
The recovery in Europe through that inventory cycle recovery has been slower than expected. And then if you add to that, it does look like Mondi has overinvested in some of their capex, and they're not generating the return. So there's surplus capacity in Europe as a whole. Mondi has played a part in that. So that's part of the problem. And I think this is a longer term story. So it's optically cheap. There's value there, but if you're going to buy it, you just need to be patient. You either need to see a strong, a sort of a really improving outlook in Europe, economic outlook, which isn't obviously on the cards yet, or you need to see some kind of rationalization in the industry, which doesn't look like it's happening. So, yeah, I think it's for the patient, or else you should wait for better, wait a bit. Don't tie your capital up yet.
Okay. I mean, Grant does say that there is value there, but JP, looking at the fact that you are a slow burner, would you be patient enough for this one?
No, not on the buy side, not on the long side. So, no, I don't like companies that don't have pricing power, that can't decide at what price they sell their product. There's some world price, and they compete against China and sometimes other jurisdictions, and sometimes there's irrational competition, and sometimes because of what's happening in China, the product that you sell is trading at a very low price, as in the case with Mondi and OCC, which is basically waste paper. And then you're in trouble, and your fate is not in your own hands. So, no, I would pass on Mondi on the long side.
All right. Well, let's get into more questions. There's a question here on MTN. Thoughts on MTN? I worry that the DOJ case against them is Trump's way to further push or punish South Africa. Is that something that investors have their eye on at this point, Grant? Because that share has actually been doing well, even with all of that.
It really does seem that the market is looking past that. This has been a long story, dragged out for a long time, and I don't see evidence that that's being priced as a major risk. Because I think MTN's, yes, it's trading still relatively good, cheap, even though it's had a good run. And I don't think it's because of that. I don't think it's because of the SEC overhang.
Okay.
I think it's more the uncertainties around Nigeria and some of that African exposure and the currency, the legacy of that, that whole hyperinflation challenges and things like that. So, yeah, I think MTN is still a reasonably good opportunity at these levels.
Okay, and I mean, a lot of people, I'm sure, were wondering if they've missed the boat on MTN, considering that Grant says it's still cheap. Would you say that it still would be a good time to get into the stock, JP?
Yeah, so again, it's a utility stock in terms of the fact that they're in telecommunication in a lot of markets that are either already quite mature, or if they aren't mature, then they've got a big FX headwind. And in the last year and a half, a lot of those FX headwinds have subsided and sometimes even turned into tailwinds. But longer term, again, it's not my sweet spot. It's not a growth company at a fair price, as we spoke about earlier. Those are the companies that I prefer. So MTN would be another one that, because of the nature of the company, sometimes such companies do look cheap, and sometimes you can buy them and you wait for other people to decide that they shouldn't be so cheap. But that's not my sweet spot. So I would pass on MTN.
Okay. This one, someone has actually chosen it as their stock pick a number of times. Not any of you gents, but it's Master Drilling. It's what's fueling Master Drilling. The other day it was up 10% at a stage with no sense or news. Is it gold and platinum moves, or in a small cap, could it be an error in someone's order price? I don't know if it was an error. Grant?
Yeah, it does seem to have been something of a fat finger, because the price spiked up and then it gave back a lot of those gains. So I wouldn't read too much into the 10% move. However, I see it is up 25% year to date. So it's ticking along, and of course it does service the mining sector, which is on the up at the moment. So I think there's some optimism maybe building in this share. It's really dirt cheap. I think it's trading at 5 times or less than 5 times earnings. And so, yeah, I mean, it's not one I'm close to anymore. I know they focus on like mining technology and drilling technology, and it's a good little business. It's just a bit small and a bit illiquid. So we don't tend to stay that close to this one.
Yeah, I think from their last results, I think it was maybe last month or a month and a half ago, it did actually post good results. JP, your thoughts on Master Drilling?
Well, Zanati, it's my favorite company from Fochville. Of all the companies from Fochville, this is my favorite.
Okay.
And I do think they have got very good raised bore drilling technology. I think as we see mining shares, especially deep mining like precious metals, doing quite well, there's an expectation that there'll be more capex, there'll be more shafts being sunk, and that is good for the raised bore drilling technology of Master Drilling.
Okay.
So if you want some Fochville exposure in your portfolio, actually it's international exposure, that's just where they are headquartered, but they make their money all around the world as they move these machines around and drill these shafts. Master Drilling is fine, but it is small and liquid, as Grant mentioned. So you can't date Master Drilling. You need to get married to Master Drilling, and you might not be able to divorce when you want to divorce. So just be aware of that.
Okay, I've got Metrofile. I think let me start off with you, JP, because you had this as your stock pick a couple of weeks ago. I hold Metrofile shares currently trading at approximately R2.90, representing a 38% profit on my investment, and would appreciate your opinion on whether I should hold and wait for the approval of the R3.25 takeover offer, or sell now to lock in my current gains. What are your thoughts on the deal certainty and risk reward of waiting versus selling at the current market price?
So that's exactly why I chose it as my stock pick a couple of weeks ago, because I do believe if you can get some more at R2.90 with a potential R3.25 in, call it 6 months from now, all goes ahead. Given the probability of the deal being voted, successfully voted through, and the deal being consummated within a reasonable time, I think that is an attractive annualized return. So personally, I would hold on. There's always the risk that the purchaser walks away. It's happened at least once, if not twice, with Metrofile since COVID. So there's always a chance it can happen again. But on a risk reward, on a probability-based basis, I do think R2.90 is an attractive price with a R3.25 exit in roughly 6 months with a high probability of that happening.
All right. Grant, I'm not going to ask you about Metrofile. Is Fair Isaac Corp one that you follow?
It's not one that I follow uniquely, but having read a little bit about it, they cover, they service, through software and data analytics, some of these credit bureaus, financial services companies. What I would say is that I think they're very well positioned. This environment now has never been better for a company who can win. Now, I think there's going to be some losers in the software space with AI disrupting a lot of these providers. They do seem to have a reasonably good little niche and know their knitting. So you need that domain expertise if you're going to survive. I don't think the generalists are going to survive. So it looks like an interesting little business, and in a space they know, and they're focusing on where they know. So I like that. But I can't tell you if it's cheap or expensive or whatever at these levels. But yeah.
All right. Well, where are you finding value right now? Your stock picks, JP.
So I'm picking a local share. Global markets are quite expensive. Still a lot of value on offer in our local market. And some shares have really come down a lot since the beginning of the year, as we've sort of gotten deflated after the GNU positivity of late 2024. One of those is Famous Brands. Okay. So I chose it in, I think it was May 2024, at around 50 Rand, and it went up to, I think, almost 70 Rand, and it's almost back to where we were at just over 50 Rand. And I do think that even though things are tough, the consumer is under pressure, people are potentially having second thoughts about buying so much takeaways because it's getting expensive to buy a burger or a pizza or a piece of fish relative to cooking at home. At the same time, people are time poor. And Famous Brands has got a selection of quick service restaurants that offer decent value compared to the alternatives. I like the franchising model. It's capital light. It's a very cash generative business. And it's at a relatively cheap valuation. So as long as they can stop going backwards or sideways, and with a little bit of hope that, who knows, a year from now, things in South Africa look better, stronger economic growth, then I think a company like Famous Brands and its shares will be a beneficiary thereof.
All right. Grant, where are you finding opportunity today?
So also sticking with the SA theme, as I have recently, I think there is going to be money coming for opportunities in SA. So my pick today is Sanlam. It's a broad-based, financial services. You're getting a lot in that insurance. The stock's done nothing for a year. It's basically flat over the past year. It is a high-quality business. It has actually pretty good growth prospects. It's trading at less than 10 times earnings. Great management. Very strong franchises across Africa and SA. I like the deal they did with 91 around asset management. This is a very good business with a good track record. You can trust them. And I think you'll see a re-rating in SA Inc. before you'll see a recovery in the economy. So if you wait for that economic recovery, you'll have missed the boat on some of these good stocks like Famous Brands or Sanlam and some of the others as well. So that's my pick tonight, Sanlam.
All right. Well, thank you so much, gents, for educating us today and analyzing the questions that we got from our viewers. That is all for Stock Watch tonight. Thanks to our guests, Grant Nader from Benguela Global Fund Managers and Jean Pierre Verster from Protea Capital Management. Up next, the close. Stay watching.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.